Cognitive Errors versus Emotional Biases introduces the behavioral finance concepts that explain why investors often make irrational decisions within the program. Traditional finance assumes investors are rational and consistently maximize utility, but behavioral finance recognizes that psychological influences frequently affect judgment and decision-making. Investor biases can lead to poor portfolio choices, excessive trading, inadequate diversification, and emotional reactions during market volatility. Behavioral biases are broadly categorized into cognitive errors and emotional biases. Understanding these biases is important because investment professionals must recognize how psychological tendencies influence both their own decisions and those of clients. Effective portfolio management therefore requires not only technical expertise but also awareness of human behavior and decision-making limitations. Cognitive errors arise from faulty reasoning, imperfect information processing, or limitations in human analytical ability. These biases occur because individuals use mental shortcuts, known as heuristics, to simplify complex decisions. While heuristics can improve efficiency, they may also produce systematic errors in judgment. Common cognitive biases include overconfidence, anchoring, hindsight bias, representativeness bias, and confirmation bias. For example, investors may anchor excessively on past prices or seek only information supporting existing beliefs while ignoring contradictory evidence. Cognitive errors are generally considered easier to correct through education, improved analysis, and disciplined decision-making processes because they stem primarily from flawed thinking rather than emotional attachment or psychological impulses. Emotional biases, in contrast, result from feelings, impulses, fears, or psychological preferences that distort rational investment behavior. Emotional biases are often deeply rooted in personality traits and are therefore more difficult to overcome than cognitive errors. Common emotional biases include loss aversion, endowment bias, status quo bias, self-control bias, and regret aversion. Loss aversion causes investors to feel the pain of losses more strongly than the satisfaction of equivalent gains, leading to overly conservative or irrational decisions. Emotional biases frequently become more pronounced during periods of market stress or uncertainty, when fear and greed strongly influence investor reactions and portfolio management behavior. The topic emphasizes important differences between cognitive and emotional biases. Cognitive errors originate from mistaken beliefs or faulty information processing and can often be addressed through education, objective analysis, and structured decision-making frameworks. Emotional biases, however, stem from psychological comfort, fear, pride, or emotional attachment, making them more resistant to correction. Investment professionals therefore use different approaches when managing each type of bias. Cognitive errors may be reduced through improved research, quantitative models, and analytical discipline. Emotional biases often require adapting investment strategies to accommodate client preferences and emotional tolerance, rather than attempting complete elimination. Understanding these distinctions helps portfolio managers provide more effective behavioral coaching and investment guidance. Behavioral biases can significantly affect portfolio performance and long-term financial outcomes. Overconfident investors may trade excessively, underestimate risk, or concentrate portfolios too heavily in specific securities. Loss-averse investors may hold losing investments too long to avoid realizing losses while selling winning investments prematurely. Confirmation bias can prevent investors from objectively reassessing changing market conditions or deteriorating fundamentals. Emotional reactions during market downturns may lead to panic selling and abandonment of long-term investment plans. Consequently, behavioral biases often reduce risk-adjusted returns and undermine disciplined portfolio management. Recognizing these tendencies is therefore essential for improving investment decision-making and maintaining consistent long-term investment strategies. Overall, topic demonstrates that investor behavior is influenced not only by financial analysis but also by psychological biases and emotional responses. Cognitive errors and emotional biases affect how investors process information, assess risk, and respond to market conditions. While cognitive errors can often be mitigated through education and analytical discipline, emotional biases may require behavioral adaptation and careful client communication. Behavioral finance provides valuable insights into why investors frequently deviate from rational decision-making assumptions underlying traditional finance theory. For CFA candidates, understanding cognitive and emotional biases is essential because successful investment management requires managing both quantitative financial risks and the behavioral tendencies that influence investor actions and portfolio outcomes.